Hey everyone, welcome back to All Things Buying a House. I am one of the co-hosts, Lisa James, and I have Taylor Nevitt here with me.
Hello everyone.
Today we're going to talk about reasons to refinance. We thought this would be a really good topic to cover because we've been doing quite a few refinances lately, just with where the market's at and how the rates are moving and things like that. So we'll kind of just get into it. So basically the first step in deciding whether you should refinance is to establish your goals. What is the reasoning behind wanting to refinance? Do you want to lower your interest rate? Do you want to pull money out of your house if you have enough equity in order to pay off bills, take a vacation, maybe do some renovations, things of that nature? So those are the two main types of refinances that there are. So let's get into the first one, the rate and term refinance. Now, depending on what type of loan you have, which we've talked a little bit about in previous podcasts, will depend on what type of rate and term refinance we do. So if you have a conventional loan, it's a regular rate and term refinance. And what that means is that you are lowering your monthly rate and then adjusting your term. So whether it's a 30-year, a 20-year, a 15-year, so on and so forth. That would be a rate and term. We're just adjusting the rate and the term. If you have a previous FHA loan, then we can do what I've called before an FHA streamline. If you have a VA loan and you just want to lower your interest rate, it would be a VA IRRRL, which is an interest rate reduction loan. So those two are awesome. They allow you to do the refinance without having to get an appraisal. Also, you don't need any income for those, and you only need a mortgage-only credit score, which basically just shows that you have been paying your mortgage on time. If you do a conventional rate and term, that one does require that we get an appraisal. We have to make sure there's enough value in the house to do a refinance, and then we will need your income, normal credit score. It's a normal loan. The main differences between the conventional versus the FHA and the VA is that the FHA and the VA will still have the monthly mortgage insurance premium. Conventional, depending on where the value of your house is, you could potentially get rid of your monthly mortgage insurance if you did have it already. If not, then you stick to not having monthly mortgage insurance. You also can go from an FHA to a conventional, and you can go from a VA to a conventional. Most people will do that on the FHA side is one to either get rid of the mortgage insurance because FHA has it no matter where the value of your house is. On a VA, people will do it so that they can reuse their VA loan to buy another property because you get your full entitlement back once you've refinanced out of a VA loan. So there are a couple reasons why you would do that. Now, with all things, your credit score is a factor in your rate. When we look at doing a refinance for you, we will take a look and see how much we can drop your monthly or how much we can drop your rate for the loan. That does make a big difference. If you're not saving at least, I would say $100 a month by doing the refinance, then we don't personally think it's worth it unless you're absolutely dead set on doing it. We always make sure that our clients are saving at least $100 a month on their monthly mortgage payment, if not more, when we go to do a refinance. Now, in FHA and a VA, you have to drop your rate at least 0.5%. So if you're currently at a 4.5%, we would have to drop you to a 4% in order to even do the loan. That is their guideline for that. Conventional doesn't have the same guideline. We could drop you as little as an 1/8. But again, we're going to look and see if that makes sense. The other option outside of a rate and term is to do a cash out loan. Now, those ones are super awesome. Some people will do them because they've racked up some credit card debt or loans and they want to get them all paid off. And a lot of the time it's cheaper. The rate with a loan through your house is cheaper than like a credit card rate or a personal loan or things of that nature. So some people will end up consolidating all of that credit into their mortgage loan. We can totally do that. Again, we're going to look and see how much it's saving you a month and see if it's valid to go ahead and do that for you. The other thing that we have to make sure is that you have enough value in your house. If you want to do a cash out on an investment property, then your loan to value, so what the loan is versus what the value of the house is, cannot be above a 75% loan to value or LTV. If you're doing a regular conventional, we can usually do a cash out up to an 80% LTV. So that is something that we look at. That's why the appraisals are so important, to see what the value of the house is going to come in at. The other reason people will do a cash out loan is they will take money out to do remodeling of the house. If you want to remodel your kitchen, your living room, a bedroom, a bathroom, anything like that, that can get pretty expensive. And again, a lot of the times it's cheaper to do it with a cash out loan through your house than it is to take out some type of personal loan or a loan through one of, the big retailers. So people will do it for that. And we've also had people who take cash out just to take a fun vacation, and that's totally allowed. But again, you want to make sure that it fits into your goals. It fits into your monthly budget. When you're taking cash out, your loan amount is going up. So most of the time, your monthly mortgage payment does increase. Now, again, as the lender, we will take a look and we are going to try and find the best rate and the best program possible to not go up that much. But very rarely do people take cash out and not increase their mortgage payment. So that's something that you do need to keep in mind. So if you're really just trying to lower the mortgage payment, then just a regular rate and term refinance is going to be the way that you're going to want to go.
Is the rate in term or like the streamline, is that like you keep your same loan kind of thing, and then would conventional be like almost getting a whole new loan if you need an appraisal and everything?
That's a great question. No. So they're actually all brand new loans that you're getting. So what we do is we pay off the old loan. So we get a payoff from whoever your servicer is. It could be the company you originally went through to get the loan, or they could have sold it off to another company. But we get what's called a payoff. And this is all included in your loan amount for the refinances. So let's say you owe $100,000, so your payoff is $100,000. We would be paying off that loan, and then you would be getting a new loan. So the way that a lot of lenders will do it, because there are, fees to do a refinance, just like with any loan, you have your escrow fees, you have your lender fees, things like that. We'll take whatever the payoff is, so $100,000, and then we add the fees into that loan amount. So, $105,000, $110,000, depending on whatever the fees are with whatever lender you're going with, and escrow. And we wrap it all in, and then we give you that new monthly payment. But yeah, you are with a new company. So it's a great question. You're with a new company. The reason that the FHAs and the VAs don't require an appraisal is because you already have that type of loan and they've already gotten your value, so they go off of whatever your previous value is. Okay. Conventional isn't like a federal-based loan, right? It's Fannie Mae, Freddie Mac, but it's not a government-based loan, and so they want to get what the new value is. But that is a good thing for you because, like I said, you could potentially get rid of mortgage insurance if you previously had it. If you didn't previously have mortgage insurance, then more than likely you're not going to have mortgage insurance when you do your refinance. The other reason that people will do a rate and term is to lower their term. So some people will have already paid into their loan for 5 or 10 years, and they don't want to get another 30-year loan. They want to get a 15-year or a 20-year loan. And we do those. I do have one lender that I could literally do any amount of years that you wanted, like 8, 9, 10, 11, 12, like they offer every single amount of years. Rates differ on each one. A 15-year loan, basically what you're doing is you're taking what you would do in 30 and you're paying it off in 15. So that payment is a little bit more. But if you've been already paying on your property for 10 years, then your principal balance is going to be lower, and that could actually potentially save you money because you're paying a lot less interest.
Yeah.
So a lot of people will do it specifically for the term reason, which would be to lower the term. Other people want to be in a better position. Maybe, their current mortgage payment is a little much and they want to save a couple $100s, and they've paid into it for 5 years. And so they'll do another 30-year loan because then your payment's going to go down because you're paying it over 30 years. You end up paying a little bit more interest that way, but for some people, that's just better for them as far as a monthly payment.
Right.
So we do them for that reason. Another big thing to know about refinance, which the lender will do for you, is with your closing costs that you're going to incur, we want to make sure that you're able to recoup those closing costs within 3 years of the loan. So we have a little bit of a math equation that we do kind of behind the scenes. But basically, we take how much you're saving and then we divide that into what your closing costs are, and that gives us a number, and that's the number of years that it's going to take you to recoup those closing costs. So if you aren't going to recoup, let's say, the $10,000 in closing costs at the end of 3 years, we will tell you that the loan isn't worth doing. It's too expensive and it doesn't make sense. Now, we don't include your escrow, like your property taxes and insurance that we collect for to create you a new impound account, because that's something that is always going to be there. So we don't include that in that calculation. It's just strictly escrow fees and lender fees that are included in that calculation. But we will do it on every single refinance to make sure that you are saving the right amount of money and you're not paying too much to do the loan. Now, if you want to pay, 2 points and get a really low rate, that is perfectly acceptable and that's up to you, but that's your decision as the borrower. As a lender, we won't recommend that for you. Usually we can get you a great rate with, barely paying any points. So we're never going to recommend that to you, but you do have that as an option as a borrower to do that. So I think that is pretty much it for this one, unless you have any other questions, Taylor.
I thought for the deciding how many years and that kind of thing, because you can also can't you get in trouble or whatever if you pay off too soon, right? You can't do that, so that's why you start with the 30-year and stuff like that.
So that depends. There are lenders when you originally get your loan that have an early payoff clause. There are lenders that do that, yes. Yeah. So whatever is in that contract, most standard lenders, we don't have an early payoff clause. Now, we do have something where we will ask you not to pay off the loan before your first 6 mortgage payments. So if you close in March, your first payment will not be until May, right? Because you skip a month. So your first mortgage payment would be in May. So starting from May, 6 months after that point, we ask you to make at least 6 of those mortgage payments before you refinance again. And one, it's for the lenders. We do get we get hit with an early payoff and we have to pay back our commission on those loans. So that hurts, whatever lender that you went with. But on top of that, it's not good for the market. It's not good to have a ton of people doing multiple refinances in a year. I know rates do get kind of crazy and they go up and down all the time. But for the market and the economy, it's just not a good thing to be refinancing that much. Matt Ashiba, who is the CEO of UWM, I think he's the CEO, he might be the president, but he works at UWM. He actually gives a really good speech on this. Taylor and I were privy to it at an AIM event that we went to that's for mortgage brokers, and he talked to us about it, and it was a really cool thing, and I got knowledge that I didn't have before, and I kind of understood where he was coming from as far as the market and people continually like refinancing.